I had a client sit down across from me last year, $1.2 million saved, retired at 64, no debt. By every measure, he had done everything right. And then I pulled up his tax return. He was paying over $40,000 a year in federal income tax in retirement. Not from a salary, not from a business, because nobody had ever built him a withdrawal strategy. We made four changes, and the projected tax savings over 10 years exceeded $180,000. Same assets, same income, just a better plan. Most retirees overpay taxes not because they earn too much, but because they never had a coordinated plan. The IRS does not retire when you do. Every dollar you pull from the wrong account in the wrong year is a dollar you're giving away for nothing. Today, I'm covering four strategies that need to run together. For a retiree with $500,000 or more, these are not optional. If you want to see how this applies to your specific situation, I put together a free video. The link is in the description. Now let's get into it. Here's what nobody tells you about Roth conversions. The single best time to do them is after you retire. The window opens the moment you stop earning a paycheck, and it closes when your required minimum distributions or RMDs kick in at 73. It's one of the most valuable tax opportunities in all of retirement. Your income has dropped, your bracket is now lower, and every dollar in your traditional IRA is a future RMD you'll pay in ordinary income tax on whether you need the money or not. This is the window, and most retirees never use it. Each year that you're in the window, you can convert a portion of your IRA to Roth, pay the tax at today's rate, and then from then on, you have tax-free growth, you have smaller future RMDs, and your heirs can inherit your Roth IRA completely income tax-free. How much do you do? I like to fill out current tax brackets without spelling to the next one. So for married filing joint, you have the 22% bracket, which runs to about $206,700. If your other income keeps you well inside it, you can convert at the 22% bracket, which beats your heirs paying it at a possible 32% or 37% later. Most retirees pull money from their accounts in the wrong order, and it costs them thousands every single year. The rule of thumb that I like to use is taxable brokerage first, because you're only paying long-term capital gains and you can usually control them. Second is the tax-deferred vehicles, such as your IRA or 401k, where every dollar is going to be taxed in ordinary income. But the question is how much and when. And the Roth you save for last. It's completely tax-free, so you want to preserve it or deploy it strategically. But the right sequence isn't fixed, it's dynamic. You recalibrate it every year based on your bracket, your Medicare costs, your RMD trajectory, and your goals. Here's the problem with defaulting to the IRA first. That income stacks on top of your Social Security, potentially pushing you into a higher bracket for your Social Security to be taxable, up to 85% of it. It can also trigger a Medicare surcharge that you never saw coming. The sequencing decision and Roth conversion decision must be made together. They compete for the same bracket. You can't optimize one without the other. I want to talk about capital gains now. Did you know there's a 0% federal capital gains tax rate? In retirement, if you plan correctly, you might even qualify, even with $500,000 or more in assets. In 2026, married couples pay 0% on long-term capital gains if their taxable income is below roughly $96,700. Single filers get up to $48,350. In the pre-RMD window, before your income starts stacking, you may have room to harvest gains at zero. Sell appreciated securities in your taxable brokerage and pay nothing in federal tax. You can then repurchase immediately, and there's no wash sale on gains. Your cost basis just resets. This strategy is most powerful in the same pre-RMD window where you're doing Roth conversions. Now, remember, they compete for the same bracket space, which is exactly why all four of these strategies need to be done together and coordinated. Here's an unpopular opinion. The biggest hidden tax in retirement is not income tax, it's Medicare. There's a Medicare surcharge called IRMAA, or Income Related Monthly Adjustment Amount. In 2026, it can add up to $9,000 per person per year to your Medicare premiums. And it's triggered by your income from 2 years ago. So a large Roth conversion at 71, a big RMD, a stock sale, you could be paying a surcharge at 73 that you never planned for. The tiers for married couples start at $212,000 in modified adjusted gross income. Every conversion, every IRA withdrawal, every realized gain flows into that number. A $50,000 conversion at 22% can be a bad trade if it bumps you into an IRMAA bracket that costs you $3,400 more in Medicare. It doesn't mean that you don't convert, it just means that you got to stop at the right number. This is why we build 2 year forward income projections for every client. IRMAA aware Roth conversions are one of the highest value things a retirement planner can do for you, and almost nobody does it on their own. Now, here's what ties all four together. Every Roth conversion, every IRA withdrawal, every realized gain flows into your provisional income, which determines how much of your Social Security is taxable, as well as where you land on the IRMAA table 2 years forward. These strategies aren't four separate decisions, they're one coordinated plan You recalibrate every year. The retirees who get this right are the ones who come in with a plan before the window closes. The ones who don't are the ones that are paying $40,000 a year in taxes that they didn't have to. I put together a free video that walks you through exactly how we build this for clients with $500,000 or more. It's in the description. Watch it. If it resonates, there's a way to reach out. Everyone taught you how to save for retirement, but nobody taught you how to spend your money correctly. And that's what Retirement Ready is here to fix.